Hello, everyone. Welcome to the stock-specific class here for Thursday, January the 19th. As always, if you have any questions during the week or any questions I don't get to here in the live class or any questions that you have as you review the recording of the class, make sure you send those to Jerry at TradersPro.com. This is also the class I've been having some of the audio issues with the clicking sound. If you hear a clicking sound on the audio and it's bugging you, let me know. I can dial back in. I did that last week. I dialed back in and it got rid of it. So I can't hear it on my end, so I rely on you guys. So I don't want you to leave the class without me dialing in to try to fix it. But let me know if you do hear it. Let me see if there's any issues. Okay, so somebody is hearing it. Okay. Yeah, I'm gonna try to book a new class on GoToWebinar because it's only in this class that I have the problem. I'm gonna dial back in and see if I can get rid of it. So hold on here for just a second. Dial back in. Let me know if that fixed the clicking problem. Someone can let me know here pretty quick. I'll move on. Like I said, I'll probably see if I can set up a new meeting and see if that solves the problem, so we don't have to take time up here in the beginning of class each week. But it is a GoToWebinar issue because like I said, it's the only class that I have the problem in. All right, sounds like we're good. Hopefully that continues. All right, let's get started. Hold on here. Let's get started with the update here. Now, obviously, we on Tuesday we're talking about we're still bumping up against that resistance line. We'll look at the chart here in just a second. In fact, let's go right to the chart. I'll come back to the directional alerts, but they're not showing any sort of overbought, oversold condition, and so I don't want to spend too much time. I don't want to just kind of keep repeating. We'll come back to it, but I want to go right to the charts here because what we're looking at on Tuesday was this well-defined trend line at the tops right here, and that didn't draw that line very good. This is even worse, but I wanted to make sure it's covering because it overshot right here, but that was the gap up, and then there was a CPI report that came out that day. Didn't close above. We haven't closed above this trend line during the whole bear market, during the whole market decline. So it's been a critical area. And on Tuesday, you know, we had to kind of look at the possibilities. Okay, if it drops from here, that's what we're expecting it to do. But what if it breaks out? You know, I took a look at a couple areas here. This is a key area here. If it breaks above, if it closes above this line, that would be bullish by itself. If it went to a higher high right here, because we've had lower highs all during this decline, that would also be more bullish. However, the problem was bullish for how long? The VIX was already down below 20. You know, how much more complacent can the market get before it starts selling off? I looked at the possibility that, you know, if we did rally up, and that's still that way, because it's possible we stop right in here and break out, you know, that the sell-off yesterday was a false sell-off and we punched through. I you know, after what happened over in here, I don't have a lot of confidence that we're going to get the decline that I was feeling like we were going to get back in December. I felt like that was going to move back in December. That this was just a correction of that move, and we were going to head lower right away. It became higher, retested that line again. Could we even just come up and retest it again and then drop? Could we just kind of play that game where we're bouncing back and forth? It's definitely possible because the market is really indecisive right now, and when it's indecisive, it tends to move sideways, and that's when you see sideways movement on the chart. It's a reflection that it's the market is telling you it doesn't know where it wants to go, and that's why and another sign too that the market is indecisive is when it keeps focusing on the next event. We have a Fed meeting, and the market makes a reaction to the Fed meeting, and then it stops, and then it says, okay, well, we'll move when we see the CPI report. The CPI report comes out, market makes a little move, and then stops, and then immediately the trading crowd's like, okay, we're going to look at the Fed minutes that come out. So they're always looking at the data point that comes out, because the current data point didn't give them what they wanted to hear or give them the confidence to buy or sell. And we've been kind of in that limbo for the last couple months, where that's exactly what's happened. Is jobs report, the monthly jobs report, the focus is on that for the next couple of days, and then it immediately goes to the next thing. But the market isn't really moving, and I think that's why yesterday was pretty significant, because we got a pretty significant movement that happened without a real major data point that the market's been focused on lately. And obviously every day there's news that comes out, because you could always point to, well, it dropped because of this or it rallied because of that. You can always do that every day, but as far as the major points that the market's been trading off of the last few months, namely, like I said, Fed meetings and CPI reports and jobs reports and things like that, you didn't have a major one yesterday, and we dropped off of that. So maybe that's the market starting to find a direction on its own. We'll see. It's still a little bit early, and we haven't seen obviously we're down today, but we're not seeing a whole lot of follow through to yesterday's selling. In other words, let me erase some of these lines here. We're seeing a little bit of indecision today in the candle. Now this could change going into the close. That's an indecision candle, and whenever I'm looking at trend directions, and you always have to allow for a pause day. I do this in shorter term trades as well, that if I expect the market to go up or go down, I always allow for a day where the market kind of pauses or briefly goes in the opposite direction, because it does that all the time. You see during a drop back here, you had a big down day, you had a pause day right here, you moved down a little bit lower there. Here you had a few days where you moved a little bit sideways before declining again. You have to kind of allow for that within some of these moves. And again, it's when you see that, this is the market evaluating yesterday. Is that a buying opportunity? Is it? Do I need to be selling? I wasn't thinking about selling, but now do I need to be thinking about selling? Like I said, it was a down day. Is this buy the dip? Is it a buying opportunity? That price action, that candle is telling you kind of what's going on in a real general sense, but it can be very valuable if you know what you're reading there. You can read that momentum and see that momentum. Question here. The dollar has not moved much. Does it normally go up if the market goes down? That right now, this is a correlation that isn't always a correlation. I've talked about this before in the past in some of the updates, that this market will focus on some things sometimes, and at that time, if a certain thing they're looking at goes up, the market will go up, or if it goes down, the market goes down. But it doesn't always do that forever, and it's really important that you understand that. One of the ones that was over the last, I would say, the last couple months was the dollar. Every time the dollar went down, the market would go up. Every time the dollar would go up, the market would go down. That's not always a correlation. In fact, we're seeing less and less of that right now, and well, a good way to tell is what is everyone talking about on TV or on the financial websites. If they're saying, for a couple months there, like I said, it was almost every day. It was like, oh, the market's up today because the dollar was dropping or is going down, and that was a correlation. And so immediately everyone starts to look at what the dollar is doing, and we did it here in class. We would look to see what the dollar movement was, and we did that with high yield corporate bonds. You remember that for a while? We were looking at the high yield corporate bonds. The market was moving in the same direction as the high yield corporate bonds. And it stopped doing that. It stopped really focusing at least on that. I'm not saying it still doesn't have a little bit of a correlation there, but just the main focus on it has diminished. And that's why you don't want to get too caught up with some of these fads that the market gets caught up in. You do want to be aware of them because they can be valuable for a period of time. If the market is reacting to, whatever the current fad is, then trade it or use it in your analysis. It should never be the primary reason for your trade, because it'll change. It will usually change. And if you are just starting out trading right now and you hear everyone talking about the market moving in the opposite direction of the dollar, then you could start to believe that it always does that, and that's just not the case. It doesn't always move in the same or in the opposite direction. And we'll take a look at the dollar chart here in just a second, but I want to stay on topic here for a little bit. All right, so big down day yesterday. What was significant about it? Higher than average volume was significant. The fact that we closed at the lows of the day was significant. It was also, like I said, it was a sell-off off of that trend line where we had 3 days in a row where we were just bouncing or we're right on that trend line. Also, it was the first day that we closed below the low of the previous day. Now, this is something I look at all the time. It very often is a great indicator for confirmation to enter a trade. But it's never the primary reason for entering the trade. If you're going to get into a bearish trade every time the market closes below the low of the previous day, and a bullish trade every time it closes above the high of the previous day, you're going to whipsaw a lot. Okay, so and when it moves sideways, it does that a lot. It'll whipsaw back and forth. So it's not a great simple indicator to enter a trade. But if you use it in the context of other analysis, it works really great. And one of those is that if I have a bearish trend, bearish ABC pattern, so there's a correction within the trend, and on that C leg right there, you've been moving up on that C leg. What should happen when that ABC pattern or potential ABC pattern, you don't know for sure if it's an ABC pattern until you're looking back in the past, but it looks like a potential ABC pattern. Obviously you're moving up on that wave C as a confirming factor to enter a trade. Very often, it's not the only thing I'll look at, but it's one of the things I'll look at is, do I get a close below the low of the previous day? You get that close below the low of the previous day, and very often that leads to the start of that decline. So in other words, the big picture is telling me that the stock should drop after that correction. And then that close below the low of the previous day is telling me that it could be starting right now. And it's a pretty good timing mechanism. Now, it doesn't always work. I got burned on a bunch of trades back here where we had an impulsive down. This looked like it was a little bit of an ABC correction through here, a lot of sideways movements right here. We got a close below the low of the previous day right there. I thought, oh, here we go. And what happened, it shot back up again, and this whole pattern got blown up. You hear me talk about it all the time. Whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. The key word there is more likely. And this is why you say more likely, because it went the opposite direction there. It should have gone down out of that correction, out of that impulsive move down. But that's what makes a market, is the chart doesn't always isn't perfectly doing what we think it should do, but that's what I also want you not to dismiss the probability, though. Anytime you see that context there, 7, 8 times out of 10, you're going to get that move down, and so that's an advantage. If you can recognize that pattern, that gives you an advantage. Oops, but it's not perfect. Okay, it's not always going to work. Nothing's always going to work, and that's what creates a marketplace. Believe me, if there was something that would always work, then these mathematicians and algorithmic designers would take advantage of it, and they'd never be wrong. And all they would do is make money, and they don't. They get caught up and lose money as well. In fact, what they're really good at, what those machine traders are really good at, is just designing software that sticks to the high probability moves, and then just triggers those trades based on those probabilities. And they lose money, but they make a lot more money than they lose because they're based on those probabilities. So we as smaller traders that can't afford the big computers to do that for us, we want to learn how to recognize some of these behaviors and take advantage of them ourselves here. So, all right, my voice is a little. It's this way during all of the winter time. I always feel congested from like November to March. Maybe some of you are the same way, but all right. So where should we go from here? Let me go back to that. So you can see here, when was the last time that we closed below the low of the previous day? It was actually right here, right where I told you I got burned, okay? Because it started to move up. Here was the low of the day there. We closed right here that day. Then this day we traded below the low. And again, I'm not saying you can't trade below the low of the previous day. You're looking for a close below the low of the previous day when it's moving up, and a close above the high of the previous day when it's moving down. But there's the low there, there's a low there, there's a low there, there's a low there, here's a low here, and then that yesterday was when we finally closed below the low of the previous day. And so that's what I'm assuming is going to be the trend. And again, big move down, big volume. I'm assuming that's going to lead to another move down. Now, based on where, and we'll look at the VIX here in a second, based on where the VIX is, there's still so much complacency. We'll see this on the directional alerts as well. There's so much complacency in the market. The market is not factoring in the risk of recession. In fact, it is all focused in on a soft landing. And you know what? Maybe we will have a soft landing. I have my opinions, and one of my opinions is, again, I'd like to look at the probabilities. The Fed has never orchestrated a true soft landing. In fact, any of the so-called soft landings that people point to were not. I don't see how you'd call those soft. I mean, there was still a lot of pain and there was a lot of panic in the selling on a lot of those bottoms as well that we haven't seen. We haven't seen that panic sell off yet. That is characteristic. Now, I think we're building towards it, because with the lack of fear right now, it's just setting up perfectly to get that. By the way, people keep saying that there's a lot of people that are bearish in the market. I disagree with that. I see a lot of people that, but that's not showing up in the VIX. There's no. If there were people that were truly bearish and believing that we were going lower, they'd be buying those protected puts, and they're not. What I see is indecision really right now, and really I see the low VIX as a reflection of what's the word I'm looking for? Just disbelief or not recognizing what's coming. It's hoping that it's not going to come. It's like that storm that the weather people are saying the storm is coming, and and you're kind of hoping it's not going to be that bad, and that it won't be as bad as they're saying it is, and but you're not doing anything about it. You're just kind of hoping it'll all work out until you start to see the tree, fly into your window, and then you realize, oh crap, I better start doing something, and then you start panicking, right? I kind of see the storm coming, and a lot of these professional traders are saying, boy, I hope I don't have to spend all this money buying those protected puts. I've been beat up all last year on my trades. I don't want to lose more money buying protection. I'm hoping that the Fed has orchestrated a soft landing in the one time they've ever been able to orchestrate it, and I won't have to do it. And all we're waiting for right now is until that realization that they look at it and say, oh crap, this is going to get bad before it gets better. And that's going to happen very, very quickly. And it usually does. It's usually something that gets triggered usually in one day where something comes out and finally the market just freaks out. I'm not saying that yesterday's move was necessarily the start of that. Like I said, there's really nothing that you could point to that would be a big reason for the market to suddenly freak out. Could be an earnings report of some sort that freaks it out. But we have Netflix today, but a lot of the big earnings coming out are going to be in the first part of February. So it could be that we drop a little bit or we bounce around a little bit. This is maybe the start of the move down. Maybe we correct that or bounce around sideways a little bit. Then when those earnings come out in February, the Amazon, Apple, Google, and all that, maybe that's what triggers. I don't know. I don't know what the trigger will be. Now, we also have to, again, consider what happens if this is a indecision day and we come right back up again. People look at this as a dip buying opportunity, where you still have to be focused on that trend line. Again, it hasn't broken above that or moved above that trend line during the whole decline. If it does, okay, then we'll talk and we'll start to reevaluate. I think if it does with the VIX down at these levels there, like I said, I just can't see it rallying for very long without going into a bigger correction. Oh, and when I was on that 2-year chart, again, I showed you this on Tuesday, but again, the worry is that if we do, this is just wave A, and that maybe we do break out of that range and rally up, but how far would we rally? Probably up into this area right here for wave B, and then you get the really bad wave C selling coming down right here. So all it would do is basically just delay that bigger drop. Now that could change again if we start rallying and for some reason the Fed does orchestrate a soft landing. By the way, and again, these are opinions, and I know, the main focus is on the charts, and I do. That is the main reason for my decision. That's why I told you on Tuesday if we did break out, well, we're breaking. That's what the chart is doing, so we got to follow that. But I've done a lot of study over the years of trading psychology, human behavior in trading. And I've seen it play out, and that's why if you're wondering why I'm so pessimistic about what's coming, it's because I know about I know what the Fed's doing, and they're doing it because they understand human nature. They know if they suddenly take the foot off the gas right now, what's going to happen is the market is going to take off, and it's going to get and inflation is going to go right back up again. The reason why I know this is I've got people that I've formed relationships over the years that I've consulted and helped with trading, and very wealthy people. And I don't hear from them in times like this at all. They're usually off doing other things, and usually they're, a lot of them for it's kind of ironic that they all seem to be gamblers, so to speak. They like to gamble, but as soon as they sense that the market conditions the interest rates are going to come down, they contact me and they want to be in the market. They want to be trading because they know that the market will just take off. We saw it happen with COVID. COVID had the big drop, and then suddenly I get all these people contacting me. As soon as the Fed dropped the interest rates to zero, they wanted to be in on the market. Then what did you see? What did we get out of COVID? We got the SPACs, right? You remember trading those things? Those things were, I mean, it was the internet bubble all over again. You know, in the internet bubble, all you needed, you had companies that were publicly traded that didn't even have a business. They just had a business plan, an idea. We want to sell diapers on the internet. Oh, okay, I want to invest in you. They weren't even selling diapers yet. They just had a business plan, and people were throwing money at them, and it just and obviously those businesses didn't survive, and some of them didn't even plan to survive. They were just taking the money that they were being given. Same thing happened with the SPACs, and now we don't talk about SPACs. Why? Because a lot of them got obliterated. And that's what fuels inflation. That's what fuels the market taking off, and because greed is rampant, and I've seen market greed. And that's one thing that you read in trading is fear and greed, right? We use fear looking at the VIX, but we can also see the greed when you see things take off with the VIX low. You don't want to trust that rally because it's not likely to last very long. So the point is that I know what the Fed is doing, and they have to break the spirit of the market to get inflation under control. Otherwise, it takes off again. Yes, you avoid a recession, but now you've got inflation again. And remember, how long it took almost a year to start bringing inflation down. Then you prolong it now to where you've got a 5-year period where you were dealing with inflation instead of a 2-year period, right? And the better outcome, the lesser of the two evils, because both of them are going to hurt, but the lesser of the two evils is to slow the economy down, create unemployment, give people a reason not to spend. And obviously, if you lose your job, you immediately go into no spend mode, right? And what do we hear a lot this week? We heard Amazon laying off people, Apple laying off people, and so what's that going to do? It's going to cause people to be fearful to spend. It is going to slow the economy down, but it's also going to take care of the inflation problem. And people have to be hurt enough. This is what people don't understand about human nature. If you touch it against the stove and you get a little burn on your hand, that doesn't stop you. Okay, you had pain. Okay, but it's a little bit of pain, and you're back to doing whatever you were doing before. You go right back to doing what you were doing before. There's no change in behavior. You get a burn that causes massive third-degree burn on your hand. You got it in a cast. It's excruciatingly painful. You can't touch anything or do anything for 3 months, and now it heals up. You are going to be very careful about what you touch. You're going to be very aware of what you're doing. Your behavior will change. Now, eventually, you'll get comfortable again, and you'll get back to normal again, but it hurt you enough that you changed your behavior. This is exactly what's going on, what the Fed is doing right now. If they go right back, take the foot off the gas and start lowering interest rates, there wasn't enough pain. It's human nature. Okay, so this is that's why I can't understand why the market. Well, I do understand because the market never sees this stuff until it's too late. But I'm trying to train you to see it and understand it. And again, we're going to go off of what the charts do. But if you're wondering why I've been so bearish and why I think we still have more downside, this is at the root of that I understand that principle. And I understand that the Fed needs to create a strong enough pain to change that behavior. Otherwise, everyone will be right back out to spending again immediately when things take off again. If you lost your job for 6 months or really struggled to find a job and it was hard to find a job and you're really hurting, then when things start taking off again, you're not going to blow that extra money you just got on a 2-week vacation to Aruba. You're going to say, I better put that in savings in case this happens again. And your behavior is going to change. Now, you'll get back to where, okay, things are good again. I got my savings. Now let's go party and have fun. But you see that transition will take time, and that's what the Fed's trying to do. Anyway, I didn't mean to go off on that, but if you're not understanding the whys of this chart right here and of everything I've been talking about the panic sell-off, we haven't had the panic sell-off. And these are things that just happen repeatedly over and over again. And just like the fact that the market didn't drop off of here like I thought it would. I could be wrong about this, but this is the higher probability outcome. And that's for me, that's what I'm going to focus on until it changes. If we break out and take off, and by the way, if we break out and take off and the market and the Fed does do that and the market's going to take off again, we'll trade that. We'll profit from that, but it probably means there's bigger pain coming then, because at some point in time you're going to have to pay the price for it. Inflation will come back, and then we'll be shorting the market again. So yes, I am a little bit of a cheerleader because I want this to be over. I want to get the pain over with so we can bottom out and really start looking for opportunities. So anyway, that's kind of the condition we're in right now. It does make me pretty cautious here. Let me flip through. Told you I was going to get to review some of the other charts here. It does make me cautious about wanting to jump into too much. By the way, yesterday I did add those inverse ETFs to the portfolio. I didn't get into all three. I got into the SARK and the SPYX, I think it is. Anyway, we'll get to that. I'll show you what I did in case you want to follow along, because like I said, these should go up if the market continues to go down, and that's what we've been doing as far as a hedge here lately. Bond market, we're getting real close. I told you we're watching this area here and this area down here. A break above here would be bullish. We're getting close to that area there, down a little bit today. We'll see at this far of a retracement. We've retraced past that 50%, would probably put the odds of breaking out higher, a much more likely outcome there of breaking out higher. Could it be that this is just a giant wave A, wave B, wave C, and it does break out higher, but it's just a bearish ABC pattern? It's supposed to be B, and then it declines further. Yeah, that's possible. But at least in the near term, that's what we're looking at. We'll see if right now it could go either way still. But like I said, as far as it's retraced this drop, as soon as it moved past that 618 retracement, these are Fibonacci levels. The probability is more likely that it's going to break out to the upside there. We'll see if it does. Gold continues to be pretty strong. It did come back a little bit yesterday. Now, I got out of GDX on Tuesday. We did have a bearish inside day. Didn't drop very much off of that, though. And then we're right back up. We're still bumping up against extreme reversal risk up here. You know, we were a little bit further over to the right side before yesterday's little pullback, but because the market is still looking a little bit bearish here. I think a lot of things could just come back. I'm just continuing to hold the other gold mining stock that I have. I told you I could jump back into GDX, but I'd like to see a little bit of a bigger pullback there on the GDX or on gold before I jump back in with the GDX. Now, keep in mind though, commodities can stay overbought for a while. I've seen gold and silver. They're already extremely overbought, but they just keep going up and up and up, or down, down, down. I've seen them oversold for long periods of time as well. And so if you're in these trades, you don't necessarily want to just get out. I got out on that trade just because of I was just kind of teaching a point of you're in an extreme overbought condition. You have a bearish inside candle. From a probability standpoint, that's signaling a little bit of a pullback. If you do get a little bit of a pullback, you can always get back in again. And that was kind of the reasoning behind that. But you could, knowing commodities can tend to run overbought or oversold for a while, you could just let it keep going. Let's see how far it goes. You don't, and that's the case with almost any trade. You're not, if you're already in the trade, you don't want to just get out because you're in the extreme overbought stage. But it's a very risky time to get into a new trade when you're running that extreme. You don't want to be buying a lot of overbought stocks, wait for the next correction or pullback, and then get back in. All right, oil. I told you on Tuesday to keep track of this area right here. That was the lower high before the recent lower low. Now we traded right up to it yesterday, and then reverse. There's a bearish engulfing candle right there. Today there's a kind of a bullish inside day, so there's a lot of indecision going on right here. We'll see. If it breaks out, that would be more bullish for oil. If it starts to decline, obviously it could come back down and retest these lows again. Overall, though, the oil's been just a sideways range. It's not trending strongly in a direction, so we don't want to just assume that we need to recognize that it has been indecisive. I tend to stay away from trading a lot of charts that are indecisive, unless I'm doing just very short-term type trades with some of these. Here's a chart of the dollar. Now, I told you on Tuesday, I said the dollar was getting oversold, but that it didn't have to necessarily go up in order to alleviate that. I said it could just start to move sideways, and that's what we've kind of seen. It's seen a little bit of a sideways move. Now, yesterday, you could call yesterday a little bit of a bullish reversal candle, although you have a little bit of a bearish inside day today. It is oversold. Could we see the dollar rally a little bit from here? Yeah, but it could be just something like this, where it is in a corrective mode within the downtrend. Clearly, the trend is still down, and so we're going to assume that that's going to continue until we see something different. But you can also see where you haven't had an exact correlation with the dollar in the market every day, and so you just want to be a little bit cautious on drawing that. Although in this state right here, I would be surprised if the dollar does rally, if that would be another factor that would put a little bit of pressure on the selling in the market as well. If somebody had a big jump, the dollar had a big jump, it might be one of those things that, because the market is still looking at that correlation, and could that could be quote unquote the reason for selling on a particular day. Oh, the dollar just jumped. That's bad. And that could still have a reaction. The VIX, again, this is something I've told you to keep an eye on. I think it's interesting to point out the reversal today, though. So yesterday we got to move up in the VIX off of that sell-off. So a big sell-off day, but what concerned me a little bit was it didn't. We're all we did was get up to 20. We were down here at 18. We get a sell-off, and we're down here at 20. Remember, 30 is just fear. It's not even panic. It's just the fear. And we're not even there, not even close to there. And then today we kind of spiked up early, and then the market kind of reversed. And the VIX has come back down. It just blows my mind that that complacency is so prevalent right now. But again, this is where sometimes it can be frustrating as a trend trader. Again, we're just following what the professionals are doing because they're the ones that move the market. And sometimes you see things that and wonder why they're not seeing it. But it doesn't matter. It doesn't matter. It does not matter at all that I think the storm's coming. I can't cause the market to move down because of that, and I have to wait until those professional traders see it as well, or maybe they don't, and it rallies. Like I said, sometimes you have to be just real patient and wait, and that can be the most frustrating thing sometimes, to wait until that happens. But these indicators being this low is not bullish for the market. It's warning that things should get crazy here pretty soon. By the way, I did point out on Tuesday that what we were seeing on Tuesday was a little bit of a mixed market condition. I think it was the Dow that was down, the Nasdaq was up or something like that, and the S&P was basically flat. That usually when you get mixed markets, that tends to be a little bit of a bearish signal, not an immediate bearish signal, but it's not usually bullish. In a bullish condition, you want all the indexes to be moving in the same direction. Maybe not, obviously not by the same percentage, but in the same direction. And when they're not, that's usually a little bit of a warning sign. Like I said, don't take that as being immediate. It doesn't always mean that it will play out immediately. But it is important that is a signal that it's a market behavior that is bearish. And like I said, not every bearish action leads to a bearish move, but again, the more of these little signals that you can line up, you see a bearish candle with or like we said, we saw the fractured market on Tuesday, and then what happened yesterday? Yesterday it dropped. And like all those things I talked about earlier in the class could be reasons why, we continue to drop from this area right here. But so that's something to kind of keep an eye on. But again, this is today's price action though in the VIX is like I said, it's come back down again. That means I've got to respect the fact that let me go back to that SPY chart. I've got to respect the fact that it's possible that the VIX comes back down to 18, and you see you're getting a little bit of we had a little bit of an indecision candle. Now we're getting a little bit of a bullish reversal candle. I have to respect the fact that maybe it moves, maybe it goes right back to that trend line again. Test it again, or maybe if it breaks out, who knows? Now, if you're looking for what's the next thing the market is focusing on, everything's focused on Netflix earnings after the bell. It's one of the FANG stocks, even though the FANG acronym hasn't really been working much lately. There's so many traders that traded those stocks that the main focus is going to be on those earnings. If they're viewed as positive, the market could easily go back and retest that trend line. If it's viewed as negative, we could see a big drop tomorrow. So that could be a reason why we're seeing just a little bit of a pause today, is there's really nothing going on until after the bell, and the market's going to wait for that and react to that. Chip stocks coming down again here. I made the argument on Tuesday this could be a little bit more of a bullish argument, that the chip stocks are are outperforming the NASDAQ 100. They tend to be leadership. But we could also see, do they start to decline sharply, and maybe at a greater pace than the NASDAQ 100? That could be something. They could be leading the way down as well if that happens. But that's something I'm keeping an eye on. If we suddenly see chip stocks break out of this area right here, because this is the resistance area that they were at on Tuesday. The market was at that downtrend line. The Dow was like this too, where it's looking to break out, and it reversed. See if it leads to a bigger correction there. All right, let's get into a couple of trades. Not a lot. Obviously, we don't want to be loading up, but there were a couple patterns, and a lot of these would need confirmation, but at least it's something we could talk about. You could put in a watch list. You go into the new buy list here, this HCC 93 strength rank. This is a coal stock. And what I would kind of look for here is, okay, oil's at a possible breakout area. We looked at that chart. If it does break out, you could see oil stocks rally a little bit further. This looks like a gigantic corrective pattern here. It had a nice little run up. Oops, nice little run up through here. In that correction, you had these lower highs, lower lows through here, and then we just broke to a higher high right here. Looks like we're breaking out. I'd like to see oil, like I said, do the same thing, but this is one that could be starting another big run up, something similar to that. I also liked this VC. Now, this is an 87 strength rank, so now we're getting down below 90 a little bit. We don't like to go down below 90 very much, but what I liked about this one is it could be developing a little bit of a cup with handle formation, which is a pretty bullish technical pattern. It's very close to breaking out, and one of the risks here is it could just move sideways. It could be in a sideways handle formation for several weeks or what have you, especially if the market sells off. Could you wait for it to break out? That'd be the safer bet with any bullish trade, to wait for a little bit of confirmation, because if it can break out, as you know, with a lot of these cup and handle patterns, you can take the distance of the top of the cup to the bottom of the cup and project that upward. There's good upside potential if it can break out, when it breaks out. And so it might be, this is probably one you just want to put in that watch list and keep an eye on. And, the benefit of doing that is that then if the market conditions turn bullish, you're already prepared. You already have these stocks that you can go look at. Now, they may not all look great at the moment that the market looks better, but at least you have something to start with as far as where to go. If you're throwing some of these in just a watch list, wouldn't be a bad idea to do that. In fact, when the conditions get more bullish, that's exactly what you'll see me do. Is I'll start building a watch list of stocks that may not be ready to go just yet, but they're close. A lot of times, I'm just waiting for them to go to a buy signal from a hold, and it's really a nice little system that you can use with the software. You find the chart pattern, you find these high strength range stocks, and then you wait for them to go from hold to buy. We're not quite there yet, but it's a pretty nice. And if you want to see what that's like, some of those classes are like, go back. You have to go back more than a year now. You have to go back probably about a year and a half or so. Summertime of 2021. And when we were still in the bull market, and you could find some of those classes. I think they're still up on the YouTube channel. You go to YouTube, type in TradersPro, but you can see what the classes, these stock-specific classes, is what it's like when you're in more of those bullish conditions, and we're using the software a little bit more effectively. It's hard to use it. You can find good stocks in a bear market. It's just there's fewer of them out there. And so out of those fewer stocks you find, again, not all of them are going to continue those trends. And so you still run into, it's just hard to make money in bear markets unless you're really good at shorting stocks or, buying put options and things like that. But it's definitely a lot easier in bull markets. And that's why, again, I want to get this sell-off over with so we can get back to building a new bull market and finding some of these beaten up stocks again. Yeah, I also like a few under the industrial products sector here. One was this BMI 92 strength rank. Definitely would need confirmation, especially since it's been down. Let me put the signals on here too, so we can see the signals. Actually, it's gone from hold to sell today, but this is a corrective pattern. So you have your bullish move. This is more choppy, more sideways. I would definitely wait for a breakout above here, above the top of that consolidation, because it might stay in this consolidation for a while, or maybe it has a deep sell right here and then comes back up. I mean, it could come all the way down here and still look like a bullish pattern. This is one you throw in there, and it's going to take a little bit of time, but you'd put it in a watch list. And then there was one here under industrial products, under the buy section. This TWI 94 strength rank. Again, it's down today, but it looks like it's in a correction, and it's kind of pulled back to the breakout area right here. So I'll look at that, or it broke out. By the way, this is what I'm talking about. This is not quite a cup formation here, but you have this little move up and then consolidated. So it's a little bit of a cup with handle formation. Breaks out. Now, when you talk about breaking out and taking the distance from the top of the cup to the bottom of the cup and projecting that upward, doesn't mean it's going to go straight there. Nothing goes straight. There's always back and forth. This would be totally normal to break out and then come back and retest the breakout. Now, if it were to dip down below here, that wouldn't be too good. See if it can hold this, start to move back up. This could be a good entry point if it can start to move back up. You have also what looks like a larger cup. This is a really deep handle right here, but you could call that a couplet handle too. The point is, it's broken out above this whole area here, and it's retested it. So if it starts to move back up again, this could be on its way. And I'm pretty bullish on a lot of the industrial stocks right now, or at least I shouldn't say bullish, but I can see potential for them to look a little bit more bullish or continue to move up. All right. Not sure if I understand that question. If you're looking at, is your question on strength rank? Strength rank is right here. I don't know if you're, or you can see the strength rank. I don't know if your question is related to strength rank, but the strength rank is right there. You'd like to see a 90. Well, we're in a really good bull condition. I'd like to see 98 or higher. And in a little bit of a weaker market condition, I'll drop down to the 90s. Otherwise, you don't find anything. You drop down a little bit to the 90s, so you're still dealing with that 90th percentile stocks out there. I get asked all the time, what is the formula for the strength rank? It's proprietary. It's like asking Coca-Cola if you can have their formula for their drink. They'll tell you can't do that. But it's basically looking at the strong, it's a relative formula, does put a greater weight on kind of the more recent behavior. But it's looking at which stocks are outperforming the rest of stocks out there. So the 90 strength rank this is the 90th percentile of all the stocks out there. These are the ones that are performing the strongest. And then you look for chart patterns, and if you know how to read trend behavior and things like that. Or if you don't want to learn that stuff, you could just stick with the 90th percentile stocks. You're more likely just percentage from a probability standpoint to capture and be able to have stocks in uptrends, without needing to learn how to recognize price action and chart patterns. But I'm assuming everyone that comes to these classes are trying to learn they do want to spend more time improving their odds, because you can always, with more education that you get on how to read trends and read price action, you can significantly improve your odds of getting into strong stocks and knowing when to get in and when to get out. That education can only benefit you. But like I said, the software itself is really designed it's designed to do both. You can do both, but it also is designed for that doctor that has no time, doesn't have interest in learning about trading, but wants to make money, and they just buy on a buy signal, go get into a stock with a high straight 98 strength rank going from hold to buy, and check the back test to see how if you get in on the buy signal, on the first buy signal after the sell signal out, the first sell signal after the buy signal, how has that stock performed over a 3 or 4 year period of time or something. You could do it that way as well. We'll do some of that when we get into, like I said, more of those conditions. We can look at back testing and all that kind of stuff. But right now we're just trying to grind out some profits while we're waiting. I did want to show you, like I said, I stayed in NEN, and it had a bearish candle yesterday, a little bit of a bullish reversal candle today. I have a pretty wide stop on this one. I'm not looking to jump in and out, but I may, like I said, gold pulls back a little bit further and then starts to go back up again. I'll probably jump back into that GDX. I also added the SARK here, had a bullish reversal candle yesterday, bullish engulfing. A little bit of an indecision candle today, but if the market continues to drop, this should go up. And so I'm just trying to make some money. If the market goes down, see if I can make some money without being short the market. I can still be long. I can still but this is an inverse ETF. This will go down when the market goes up and up when the market goes down. I've been using these to hedge a little bit. And the SPXS here, we have that bullish reversal candle on the SPY today, and a little bit of a bearish candle, reversal candle. There was a bullish candle though from yesterday. So if the market starts rallying tomorrow, I'll jump back out of this one. Probably keep the SARK. Unless it really looks bullish, you have a really strong bullish move. These can go against you pretty fast as well. So I only like to use these when I think the market is going to and even I don't jump into these if I think it's going to drop for just a day or two. It's when I think there's a bigger drop coming, I'll jump into some of these. And like what happened last month, we got the market dropped pretty good there early in December. We got this nice little run up through here, and then it started to rally and it came back down. So, what I was looking for was that bigger drop where we'd be up into this area right here. There's the October lows. So again, if we go back down to the October lows, the SPXS should get back up towards that area there. And this is one way that you can make money while you're make money when the market goes down without, like I said, without having to short. But the other one I like to use is the SOXS. This is the inverse of the chip sector. Now the chip sector was looking like it could look a little bit more bearish there. This will be a third one I'll jump into. If I see a little bit more confirmation that we're dropping, I'll probably jump back into this one too. This is the one that could really make you good money, but it can lose you money too if you're on the wrong side of it. If it got back up to the October lows, you're talking about going from $30 up to $80 there. And so that could that could make you a lot of money if we get a market sell-off. So, but like I said, it can go down pretty quick too. On this little drop right here, going from about 45 to 30. So I usually try to wait to use that one when I got a little bit more confirmation. Let's just take a peek at the SPY real quick before we wrap up. Yeah, we'll see how that looks at the close. Like I said, I wouldn't put too much weight on how that looks. Oh, shoot, I've got a frozen screen here, it looks like. Hold on. Let me restart this here just a second. All right, does that help? Can you see? So here's the SARK, bullish engulfing. I don't know how far back it froze. Bullish engulfing. This one still looks good. SPXS. It has a little bit of a bearish candle because the SPY has a little bit of a bullish candle today, bullish reversal candle today. Like I said, I don't think, these are very short term in nature, and the fact that Netflix is reporting, I think that'll have a bigger impact on how things trade tomorrow than the closing candle today. But I have the SPXS. Like I said, if it got back up to, if we went down to the October lows, pretty good move it can make for the portfolio there. And I think I had my stop. I had a tight stop on these. My stop is just right below. We had that bullish candle right there, and then I just put my stop below that. So if we do reverse and come right back, and the market rallies right back up again, I'll stop out. And then the SOXS is the one I might add. It's the chip sector one. And this is what I was pointing out was if we went back to those October lows, it was about an $85 stock. We're down here at 30. That'll make us a lot of money. But it could also lose very quickly. When this thing dropped, when this last market rally went from 43 down to 25. So you want to be pretty careful with this one. It can make you money very quickly, but if it reverses back down, it can give it back pretty quick. All right, that's all I have. I don't know if my voice will last any longer. Have a great week. We'll see what things look like on Tuesday, and hopefully, I think we're finally back to normal weeks here until, I don't know if the market's closed on, I can't remember if the market's closed on President's Day or not. I think it is. But that, at least these short weeks have really messed with me. We had the short week for Christmas, short week for New Year's, short week for Martin Luther King Day, and throws off my schedule. I can't figure out what day it is, but we'll see you on Tuesday for the next market update. Bye, everyone.